So welcome everybody to the second webinar that we've been doing. The goal is to go through the higher level quarterly reports, talk about the markets, both on a more national level as well as individual projects to some extent, but certainly more with the focus on the actual markets, which tells a lot of the story anyways, in terms of not specific assets, which we're always happy to speak about individually, but kind of what's going on with these markets as a whole. With me today is Corey Shapiro. He's Senior Associate of Asset Management. He's been with us for a number of years, and I'm happy he was able to join us today. Let's get started. So first of all, the webinar will be recorded. It'll be available afterwards. Again, it's not financial advice, and there's a disclaimer, of course, and any questions, please feel free to reach out to us at any point. We won't be doing Q&A session in this one. We kind of just want to get through the highlights, and of course, we're available at anybody's convenience to answer any questions or have a conversation. Always happy to do that. All right. For those who don't know me, I'm Jonah Bamberger, the founder of Aulder Capital, founded in 2012, so it's been 12 years. It's been an interesting ride. Brought it from a 6-unit in Brooklyn all the way through 60 acquisitions across 3 different countries, about $1 billion in assets in residential and hospitality space. Corey, you want to introduce yourself?
Yeah. I'm Corey Shapiro, as Jonah had said before, Senior Associate on the Asset Management team. A lot of oversight for existing portfolio that we have and overseeing some of the development work that we have, especially in New York as well.
So I think that in order to get a better picture of what's going on within our individual assets, I think it's, of course, important to start kind of at the high level, which is what's going on a national level. So we're kind of going to start there and then drill our way down. Of course, we'll give touch points on each one of our assets kind of as we go through it, where it becomes relevant. But the goal is kind of to take a bird's eye view and then start to drill down to the individual assets. Corey, do you want to get started?
Sure. So yeah, on a national level, you're seeing growth in the select major markets throughout the United States, seeing inventories increasing, but also a tightening of supply as quarter over quarter as a lot of these new units have been absorbed. And we're still seeing continued throughout the country rent growth. I guess it eased a bit in this quarter, but on average, we're still seeing consistent rent growth. And specifically in middle markets and in the assets that we play in, we're seeing overperformance compared to a national level when it comes to occupancy and rent growth.
I would also touch on that of course, when we talk about major markets, of course, there's big differences between, kind of high growth markets like some of the major cities in Texas, Dallas, Austin, Houston, or cities that are more traditional and struggle to grow, like New York City, in our case primarily. And we do see that those high growth have also a significant amount of inventory, which of course affects the fundamentals. Whereas in a city like New York, where there's lack of supply, then the fundamentals are very strong for rentals. So let's keep on going.
I mean, I think touching a little bit even from the first slide, but just seeing, a sharp decline in vacancy and kind of the post-COVID recovery, and that picking back up and normalizing a bit, but starting to see generally throughout the nation a leveling out to a normalcy of vacancy rates. And the same story really on rental rates as well, right? You saw a really stark increase in that 21 to 22 range, and then things leveling out again. Ultimately, I think when you take a step back and look at a chart like this, going back to 2010, generally you're seeing a pretty straight line without some of the outlier years. And we're expecting that to continue with just pretty steady rental growth going forward.
I would touch on this one. I'll wait on it. We're going to be presenting rental rates for each of our existing markets. The markets, of course, we're going to be talking about are New York, Prince George's County, Maryland, and the Myrtle Beach area. But again, here with rental rates, there's kind of a large difference between, again, a kind of a high growth area like South Florida or Tampa, Florida, where rents pretty much doubled versus, let's say, Rust Belt states, where rents are probably pretty steady across the board. Um, so again, even though there's kind of, again, especially over the course of the 14 years that this graph presents, there's kind of a steady march upwards. If a little bit of differences around COVID and then of course post-COVID recovery with that significant jump, we feel like it'll kind of level off to standardization. But again, it's definitely not across the entire United States. There's areas that are going to definitely represent that sharp growth, and there's areas that are going to be much more flat. And again, we'll get into those details on our respective markets as well.
So for a little bit of a capital markets overview, also this is high level, not really diving yet into our markets, but more so on a national scale. You saw in this quarter sales volume pick up a little bit, but it still really seems to be institutional buyers that are playing in a lower leverage space. You're still seeing some of the larger lenders, originations still have declined year over year. And it's the non-institutional investors, it's still a bit more difficult. But you are starting to see a rebound and some buyers coming back into the market regardless.
We'll talk in one of the next slides in a minute about kind of the buy-sell spread between buyers and sellers, but I think obviously this has to go with interest rates as well, which we'll get into in a second. But I think that it's important to remember that there's certain types of groups that by and large have to transact, and that's a lot of what we're seeing. Funds that have hit their large institutional funds that have kind of hit their timeline, properties that require some level of financing, whether it's their mortgage has expired or they need something that's more manageable, and quite frequently those result in a transaction. If you can't have a competitive refi and that mortgage is expired, frequently what happens is a group will have to go to market and sell it, even if it's at a discount. They simply don't have a choice, and that's where we're seeing that kind of forced types of transactions. Strong, well-valued properties tend not to necessarily fall into that category. So anything that a seller nowadays can do to hold on, they'll probably wait it out. Of course, the major influence of this is interest rates, because that's what dictates both what people expect in terms of their alternative investment opportunities, but also in terms of the financing that's available. I think it's interesting to go back, Corey, real quick. So what's interesting to see, of course, is that there's been a long downwards slide post the great financial crisis. It kind of evened out at fairly low interest rates, which was obviously had very strong effects in terms of real estate valuations by and large. When COVID hit, of course, interest rates went down even further. And then the story that we're all familiar with, inflation and so on, and the way that the Fed simply increased the interest rates to something that's quite unusual in the way that these numbers are managed. What it also means is that at some point, we expect that cycle to go down a bit. Maybe historically, it won't go down to where it is, certainly not in COVID areas, but some level of easing off. And even then, at some point, transactions will have to start to pick up again. And again, I think we can kind of see that on the next slide. What this slide shows is debt origination, which is it's a good measure of how many deals or which volume of deals are actually getting done. And what's important to remember is that the difference between this graph doesn't necessarily show the full picture, but a difference between 2023 to 2021, that's pretty close to 400 billions of dollars that has come down to less than 250. So that's a lot of that's a big drop in terms of origination and transaction volume. 2024, of course, we're only looking at Q1s and two, but what we're seeing is that it's pretty much on track to be like 2023. Again, it's much lower than what we've been seeing over the last 10 years. Um, and for all the reasons that we've discussed, high interest rates, gap between buy and sell, and people that are just reluctant to transact, be it on the sales side or on the investment side.
Yeah, no, on cap rates, I think it speaks to what Jona's mentioning now. The bid-ask spread, it's tightening a bit, and I think that sellers are a bit more realistic, but still, the expectation is that cap rates are still going to decline as interest rates do. And at this point, it's still sellers that need to sell, whether it's maturing debt or for other reasons, are more so the ones that are coming to market. And ideally, if you're in a position that you can continue to hold and improve your assets, you're doing so. But as interest rates remain steady, for the most part, cap rates are remaining steady. And even where transactions are happening, buyers, are going for quality. There's a flock to quality during this time and still looking for deals.
So I'd like to add a couple of things to kind of touch points on many of our projects, which I could talk about a specific one, be it Walker Mill in Prince George's County or Avery and Cloisters in Maryland, or even some of the New York assets that are kind of in that better position. The newer ones, not the rent stabilized ones. The reason why we're not interested in selling any of those is because by and large they're in a stable situation. So if we were to sell, it would be at a discount. The buyers out there are looking for distress, and therefore they're looking for bargains, something that we're not necessarily interested in giving. We think that in a year or two, these numbers will stabilize, the valuations will come back. Even if interest rates don't come down significantly, which they may or may not, at some point transaction volume will continue. Of course, interest rates affects construction as much as everything else. So the result of high interest rates is lower construction, lower starts, stronger fundamentals on the rental side, which results in increased values. We don't have a slide here about insurance, but one of the things we've also seen is insurance has been extremely expensive throughout the United States. Obviously, in areas that are more exposed, like South Florida, it can be even hard to come by, but it hurts NOI, it hurts the ability to get strong valuations, and it's another reason to not sell when you don't have to. By and large, even our assets that are part of the portfolio that we would be more than happy to sell, this simply isn't the right timing to get the right value. A real contrast to that is end user product. We, for example, have two portfolios that have end user products that we can sell. A project in New York called 93rd Street, where we sell apartments, and in College Park, Maryland, which is still in the value add stage. It's single family homes that are kind of used as mini dorms for students. And in those areas, that pricing has actually gone up quite significantly. People need housing. Those are looking to buy, even though interest rates are higher. The pricing is higher. The price per square foot that we're getting in Maryland, both in Maryland and in New York City, is high, stronger than what we thought we'd be able to get at this point. And that's a reflection of lack of product, of tight supply. And at the end of the day, as opposed to institutional buyers, there is constant demand for that end user product. So it really is a kind of tale of two cities. On one hand, you can see an article that says, apartment prices are through the roof. But at the end of the day, that's not the case for commercial buildings. And when we look at transaction volume, it's lower for end user product as well, but not the way that it's been, not to the same extent that it's been in the commercial space. And when I say commercial, I mean residential, because we're not really touching on office or retail or hospitality, which kind of have a different, they operate differently.
Jump into our markets a little bit.
Yeah.
You can start off with DC, Jonah.
Okay. For those of you who don't know, we have about 1,000 units in Prince George's County, Maryland, a suburb of Washington, D.C., within the Beltway. Washington, D.C. has pretty crazy regulations, meaning that it's not a strong opportunity to buy. Prince George's County, Maryland is it's one of the 100 wealthiest counties in the United States. The product that we do here is mostly workforce housing, with the exception of the student housing portfolio in College Park. The vast majority of our unit count is in workforce housing. These are working families, strong tenants, not always certainly not people that are necessarily the highest earners, but it is a working population. Throughout COVID, this property or this region had some pretty strange regulations, which were very damaging in the long term, in that many people did not pay rent and were evicted because that was the guidance they were given, which means that at peak, which was about a year ago, we were rejecting about 90% of applicants for apartments, which of course hurt our ability to maintain high occupancy. I think since then it's improved. Our occupancy has improved as well. And at this point, what we've seen is that our rejection rate's still about 50%. Again, it's kind of these COVID hangovers, people that went through an eviction process and showed that they have no interest in paying rent. Well, we're not particularly interested in renting to them. So it's been a challenge. What's interesting is that the fundamentals in this area, although certainly much softer than high growth areas, are still not bad. The turnover last quarter, for example, we had 22 units turn in one of our properties, which is about 5% of the property. This is just an example. The property I'm talking about is called Walker Mill. 12 of those were through evictions and had higher arrears. The eviction process in this area, of course, is long, as would be expected in a place like Maryland. But on renewal rates, we were able to get 2.8% of rental renewal increases, and on new tenants coming in, closer to 6%, or 5.7% to be exact. Which is, of course, as we saw previously, it's higher than national averages on both renewals and on new rentals. I think the reason for that is, first of all, because we're in that middle market space, as Corey mentioned. These aren't A-class properties, but they're also not C-class. So on one hand, people have the disposable income to push it a bit, but they don't necessarily have the income to go into an A-class property. A-class properties, of course, are in, that's where people who are a bit more conservative, a bit, more concerned about their consumer spending, and they might go down a level from A class back into B class. So our buildings, I would qualify them as solid B for the area. Again, not necessarily a place that I would want to live in, but nice properties. We try to maintain. We try to deal with what at the end of the day is fairly high crime rates for the region. Not always that exciting to deal with, but we invest in security, and we try to operate as tightly as possible under fairly respectable circumstances. It's a fairly stable market. Moving on, one more. When we look all over at Prince George's County, of course, we see a large COVID bump. Vacancy or stabilized vacancy is pretty stable, and we expect that to be as well. We're well into the value add plan on all of our properties, because we've held them for anywhere from 4 to 5, 6 years. So ours are pretty stabilized. Some tenants still, take out their frustrations on the units, and it takes time and money to get them back online. But by and large, it's a stable market, and we can see that here as well, that it's not, vacancy is fairly normal on the national standard. Next slide. Corey, I'll let you handle New York.
Yeah.
Let me sorry, I didn't, real quick, just to go back to Prince George's. My apologies. Transaction volume. We didn't put a slide for it because there is none. Transaction volume for multifamily above 50 units has dropped 97% from essentially from 2022, where there was which is kind of the base year. It stabilized at almost no transactions, meaning there was in 2023, I believe there was 2 transactions. I think this year there was 1 transaction of a larger multi-family. And now what we're seeing is maybe some cracks in the system where there might be some distress. It's not our assets, but we have seen it from lenders that have taken back properties. And maybe now there will be a little bit more, maybe in the next year, we'll actually see some ability to transact in Prince George's County. By and large, till now, everybody's just sitting on the side. Nobody's buying, nobody's selling. And it's something that we have our finger on the pulse to try to understand. But really transaction volume in Prince George's has been negligible for multifamily.
So to discuss New York City a bit and our assets located in New York, the fundamentals just remain very strong. Supply compared to demand here, I mean, the rental demand continues to increase, and you're continuing to see an increase in rents, very low vacancy as well. I mean, 2.6% of units in New York City are vacant. So even that number is made up of a decent amount of units that are in rent stabilization that owners aren't making investment to bring back online. So you really just have a very tight market in New York, and you're continuing to see that. At our properties, it's seasonal. We try to align our rents for summer expirations because that's when you're seeing the most demand and the highest bumps on rent. And I think you're always going to see maybe a little bit of a bump or a drop off in those months just as people are transitioning and there's more turnover. But ultimately, if you're bringing these units to market in good condition and at the right price, that they're being rented and they're going quickly. Our projects, if they're still repositioning, we have a couple, but for the most part, generally we're in a good spot with properties that are fairly stabilized, and we're seeing low levels of vacancy and pretty strong rent growth whenever we bring units to market. On rent stabilized properties, there's still very low interest from investment. Those cap rates are still floating around 10%, and you're really not seeing transactions unless owners are really needing to sell those type of properties. And it's obviously difficult when you have the rent cap and you have increasing expenses, and that's kind of a sub-market of its own that is just a result of New York City. I think also, just to speak a little bit to low vacancy, high demand, that doesn't seem like it's changing. You're not really having too much multifamily product come online. You have the governmental risk, and you have just very high costs of construction. It's making it very difficult to deliver new multifamily, especially without any kind of tax abatement. So you're seeing projects that were underway previously, maybe some will get done over the coming years, but you're not really seeing too much take off, especially not in some of the markets that we're in this kind of multifamily rental space. The same thing you're seeing here that we've been discussing, right? Steady rent growth, pretty high averages on rents per unit, and market growth continuing to increase, leveling off in some areas, obviously, with the spike after 2021, but continued strong fundamentals, and we would expect this to continue, and if not, even pick up a bit in future years.
I would also add to this. To some extent, even within New York, you have a tale of two cities. The situation over the last couple of years in terms of how people feel and who the city is drawing, strong areas have phenomenal rent growth. We have projects in the Upper East and Upper West Sides that far outperform areas that are more edgy areas, whether it's Washington Heights or Harlem. Previously, those areas were, people felt safer, they felt better, and we really felt like those areas could outperform. Of course, rent stabilization, and just the way that those properties function, frequently it's not worthwhile to invest in them, and then therefore the property suffers for it, whether it's on the amenities side or even just on who the tenancy is. But again, when you see these increases in rents, and I think the article comes out every couple of weeks that New York's average rents are the highest they've ever been, and so on. To a certain extent, it's a flight to quality. People are willing to overpay to be in better neighborhoods, and still don't necessarily feel so comfortable going to a neighborhood that would have previously been in some kind of gentrification or transition. People just don't feel that safe or good about those neighborhoods. So even when looking at these data, is when you look on a neighborhood by neighborhood case, or for us on a project by project case, you know, better quality, better location assets far outperform the average. Properties that are rent stabilized, and the more rent stabilized they are, the less they even meet these numbers. They really underperform.
We'll jump to Myrtle Beach and the properties we have there. So this is a more specific, interesting market where vacancy rate at 20% as of this past quarter. Really, a lot of that has to do with some new supply coming on in this market. What we've seen is probably projects that were taking off for groundbreaking in back end of 21, 22 had been delivered. You're still seeing good fundamentals and population growth in this area, but regardless, it's going to take time for that new product to get absorbed. And realistically, that product is getting absorbed with some concessions, and that's also creating just an increase in vacancy. But over time, as this product comes on, it's really for the most part Class A that we're seeing that's come to this market, and we feel still pretty comfortable where we are. As those rents normalize and as those new properties get fully leased up, we're kind of trailing that rent where we're in a good spot in a middle market, not really going for the Class A property type of tenant, but still getting a nice tenant base. And from the time that we had made these purchases, our rent growth has been very steady, either by way of renovations at the units or even in a lot of cases, just being able to get increases in rents on renewals or new leases by pretty strong demand still and other improvements throughout the properties. So I think the story overall here, and at least where our properties are in Myrtle Beach, and you're seeing that vacancy is high now with an expected decline there as some of that new product gets absorbed. This chart kind of speaks to what we're saying here. I think as you look at where we are now, you're seeing a very high level of vacancy, and that's really increased, obviously from 21 through 24 you're seeing, and the expectation is for that to normalize in the coming years.
So the one thing I'd like to add to this is, our properties by and large would be under the 3-star. That's middle market. So our properties are from 1990 by and large on the two. We have a broken portfolio in kind of the heart of Myrtle Beach, and then 2 multifamily assets that are from 1994 and 2000. So even though it sounds like it wasn't that long ago, they're by and large 25, 30 years old. So they're certainly B class at this point, and therefore priced differently and kind of for a more affordable, kind of more value play. The same thing goes for our broken portfolio, which is even a little bit more towards, kind of 2 stars or workforce housing, depending on which property it is. Myrtle Beach, in the last couple of years, at least 5 years, it's been one of the highest growth metros in the United States. And that's a function of obviously a lot of supply coming online that is being absorbed over time. So it's kind of a build it and they will come. When you go around Myrtle Beach, be it our properties or really anywhere else, you don't really meet people from Myrtle Beach. This is what's called the tweener destination. It's, in terms of value for money compared to Florida, it's much cheaper. It's on a beach. So just the cost of living in South Carolina is a lot cheaper than being Pennsylvania, New Jersey, New York. And at the end of the day, it's a 1 day drive. It's driving distance. So not just for vacation, but also for people that are snowbirds that are coming to do the season, or people that are just looking to relocate in a cheaper state. Obviously, for us, some of those people are, they come in, they'll rent for a year or two, and then decide whether or not they want to actually purchase a home. But you can feel the growth and the energy. It's in terms of the economy, they're struggling to bring it out of. It's still by and large tourism and quite seasonal in terms of that. But we do see some changes there as well, both driven by the state and by the city. So we think that the fundamentals are very strong. It'll stabilize and it'll stabilize high just because of the consistent amount of growth that, new product coming online. If even looking out in the forecast, you can see that it's higher vacancy than what we would expect on a national average. That's by and large a question of continued growth and, that has to then be absorbed.
Yeah, and I think even while we're seeing a lot of new supply come in that is being finished up and getting leased up, you're not really seeing as many new projects. I mean, you're not seeing that at all. The new projects that are coming. So it seems like it's a shorter term absorption period, and then it'll level out. And this, I think that speaks a bit more to what we're talking about, but also on rents. You're still seeing the overall rent growth over time, and it just really, in the short term, it's going to be about absorption and continuing to see this rent growth. And I think it's strong for us, especially given if we're more so in the Class B property space and kind of trailing behind some of these newer properties that are at a different rent level. That's going to help our properties to be able to increase and kind of trail there and fit a different type of resident that isn't looking for the highest end unit, but is still looking for really a quality property.
So by and large, to kind of bring it to a head, and here I'll talk a little bit about opportunities both for, because we kind of skipped it, both for New York and Myrtle Beach. We think that the current play for New York is slow and steady. Regulatory challenges, including the Good Cause Eviction Act that just passed, makes it for a tough buying environment, which means that it's not the right time to sell either. The one exception to that is rent stabilized projects that are really kind of their own story. We talked about it in the previous webinar, which is available online for anybody who wants to see it. Of course, happy to discuss as well. We think that there will be buying opportunities in New York, but it'll take some time to understand exactly what's the fundamentals are and what the story is. So by and large, it's a question of, enjoy the higher rents, manage it effectively and efficiently to avoid excess costs, enjoy those fundamentals and wait for brighter days in order to be able to execute on exit. At the same time, keep an open eye out for opportunities, but they're probably not in the near future. Washington, D.C., not an entirely different story. Manage the cash flow, distribute where we can. We feel like some of the headache from COVID is kind of petered off. We feel like these markets are more stable than they were previously. And, we are in a position to be able to manage effectively, increase rents, to the way that we can, which is stronger than national averages. Keep occupancy up and wait for the right time to sell. It's not now, maybe it's a year away, maybe less. It doesn't just depend on interest rates. It also depends on buyer appetite. I don't think anybody expects interest rates to come back down to zero. And at some point, there's other factors at play as people need to deploy capital. They need to continue to do deals. And those strong fundamentals will support high valuations. On the other hand, there are assets that are distressed. We're looking at one now, fairly close to where our portfolio is located. It's both a property that's distressed, but largely it's the operator that's distressed. They took on too much debt. They didn't manage it effectively. The project spiraled. a lender took it over, and now maybe it's an opportunity for us to come in and get it at those lower prices. Something that could be interesting, and we're taking a close look at that. South Carolina, we haven't seen that level of distress like the project I just described. A lot of the stuff that's coming up is really a story of lease up. People are not Sellers are not necessarily in distress, not really willing to reduce their prices. For us, we're still in business plan, we're still turning units, so it's kind of working itself out as we continue to renovate, as we continue to increase rents, to stabilize our assets and kind of bring them to the next level. I think it'll dovetail well with our business plan, which is generally 5 years. By the time we're ready to sell, I think the markets will be back and we'll be ready to transact. So again, the kind of wrap it up, and it covers pretty much all of our properties. This is not the time to sell because we're not distressed and we don't want to take the hit on it. Buying opportunities are far and few, but we need to take a look. For those who don't know, we haven't transacted on an acquisition in the United States pretty much in 2 years, not in 23, not in 24. Last time we bought was 2022. We have done deals in Portugal. It's of course a very different market, and not necessarily the purpose of this webinar. But slow and steady and patience is kind of the key term. I think our next webinar, which will probably be in about a month from now, so mid to late September, we'll send out invites. We'll focus largely on acquisition opportunities, deal volume, and what we're kind of seeing out there. We'll go a little bit into different asset classes as well to kind of compare, not just multifamily. And we're looking forward to being able to present that. I think it'll be an interesting one. It's been such a long time that the market's kind of been frozen, and as we're watching them begin to thaw, I think there's really a good story to tell, and I'm looking forward to that one. And that's about it. Again, please contact us. Visit us on our websites. We have a new website for the hospitality sector that kind of highlights some of that. We're always available to meet, to discuss, to answer any questions. And thank you so much for your time. Corey, thank you for participating.
Of course. Thanks, everyone.